Whenever I get calls from former students with a reporting question, it invariably revolves around trying to figure out how a particular deal or transaction will be shown in the financial statements. Will it increase or decrease net income? Does it all get recognized currently or some future period? The tool we use to answer these questions is transaction analysis, which is the required first step firms take when making a journal entry to record a transaction. This is arguably the most important tool for you to master when learning about financial reporting, and it's our focus for this segment. Now don't worry, no debits or credits here. Instead, we will use the accounting or balance sheet equation as the basis for analyzing transaction. Most people find this to be a much more intuitive approach to journal entries. Remember the accounting equation on which the balance sheet is prepared? Assets equal liabilities plus stockholders' equity? I hope so, since we've talked about it in the last two segments. This is a very useful equation because we can use it as a framework to analyze and record all the financial transactions entered into by a company. Before I show you how we do that, let's separate out the income statement accounts that are embedded in the retained earnings section of stockholders' equity. To do that, recall that stockholders' equity is generated in two ways: from investments made by owners in exchange for stock, which we capture in the common stock accounts, and from the earnings or net income that are retained by the firm, what we call retained earnings. Retained earnings is really made up of the cumulative net income the firm has earned over its lifetime, less any dividends it has paid out to shareholders. Thus the name retained earnings. And finally, we can break net income down into its main elements, revenues and expenses. When the balance sheet is decomposed in this manner, it's easy to see why I say that income statement is really just a subschedule of the balance sheet. It helps to provide more detail on a key element of stockholders' equity and retained earnings, net income. The expanded formulation of the balance sheet equation then can serve as the basis for recording the many buying and selling transactions the firm engages in during the year. The main rule is that after making a journal entry, the equation must be in balance. In other words, if a transaction causes an increase to an asset account, this must be balanced out by a decrease to another asset account, or an increase to a liability or stockholders' equity account. Otherwise, the equation will not be in balance. Thus, a journal entry will always require at least two entries to keep the balance sheet equation in balance, what is often referred to as double entry bookkeeping. To make this format a little easier to use, I like the template you see here, which makes use of a spreadsheet format, which can easily be created in whatever spreadsheet software you prefer. Here you see we have the headings for the assets, liabilities, and stockholders' equity sections. Within each section, we can add columns for individual accounts, or just leave the columns as general headings. This is totally up to you and how much detail you want to record. Since so many transactions involve cash, I've created a separate column for increases and decreases to cash, and will record any other asset in the other asset column. You'll also note that I've broken out separate columns for revenues and expenses, with a total calculated for net income. This just makes it easier to see the changes to net income as they occur. Whenever you record an amount in the revenue or expense column, net income will increase or decrease, and so will retained earnings. Thus the arrow showing the connection between net income and retained earnings. Let's see how all this works with a few transactions that don't involve any revenues or expenses. We'll look at those next week. The first transaction we'll look at is the purchase of fixed assets. Assume the firm buys $10,000 of equipment for cash. Although this is a fairly simple and straightforward transaction, the first step in determining what journal entry to make is to figure out exactly what the firm is giving up and what it's receiving in the transaction. This will help you to identify which accounts to increase or decrease and by what amount. Here, the firm is giving up $10,000 of cash, so cash decreases, and is receiving $10,000 of equipment, so the other asset column is increased by $10,000. Note the summary effect of the journal entry: one asset decreased, cash, and another asset, equipment, increased by the same amount. Thus the balance sheet equation stays in balance and the journal entry is complete. Next, the firm borrows $50,000 cash. They receive $50,000 in cash and they give up a promise to repay the $50,000 according to the terms of the borrowing, which are not specified here. This promise to repay fits our definition of a liability, an obligation of the firm requiring payment in goods or services that is the result of a past transaction. Thus, the journal entry will consist of an increase in cash of $50,000 that is balanced by an increase in a liability account, note payable of $50,000. The balance sheet equation stays in balance and the journal entry is complete. Let's look at a stock transaction. Assume the firm issues, or sells as we say, 10,000 shares at a price of $5 per share. What has the firm received and what have they given up in exchange? Clearly, they've received $50,000 for the stock. In return, they've given up ownership rights in the firm, which at the time of the transaction are worth $50,000. So the journal entry to record this will increase cash $50,000 and increase stockholders' equity via common stock by $50,000 as well. Note that the $50,000 increase to common stock and stockholders' equity represents the market value of the stock on the date the firm issues the stock to the public. While the market value of that stock will then change from day to day, the firm will not make any journal entry to recognize that change in market value. Instead, the common stock account will always remain at the amount originally invested, in this case $50,000. Now assume the firm decides it doesn't need all its cash for current operating needs, so it invests some of its extra cash in a stock market fund. It spends $1,500 and acquires shares in a stock fund. Cash of $1,500 decreases, and in return, a short-term investment account, an asset, is increased. This entry is similar to our first entry, when the firm purchased equipment. Buying any asset for cash will result in a decrease to cash and an increase to another asset account.